Today we're talking about real estate investment trusts. You know all those massive grey buildings on the side of the road? Well, someone owns them, and generally it's not the company who has their name printed on the side. It's some other group that takes rent from that massive company. So let's get on the app and start buying them. Hi guys, welcome back. If you've never seen me before, my name's Paul. A couple of months ago I started investing and I made a shit ton of mistakes. Then the market crashed and now I'm trying my best to claw all my money back and make some good investments. So the idea of this channel is that if you're new to investing, you can look at my videos, see where I went wrong and hopefully not make the same mistakes. Today we're talking about real estate investment trusts, or REITs for short. Again, it's another problem with the investment world where they've got such a fancy name which doesn't really mean anything to you and it makes things complicated and scary. But really, REITs aren't complicated at all and they're exactly the same as any other normal stock. REITs are a category of stock that own buildings and then rent them out to companies. So you've got your big box warehouses, you've got student accommodation, you've got care homes, you've got hospitals, and you've got shopping centres and anything else that fits in between. Most of the money used to buy or build these buildings generally comes from money from investors. That's you or I investing in the company so they can build more stuff. And because they get that money from us, they can be quite generous with their dividends, which makes them a positive target for someone like me. That's REITs as simple as you can put it. And to be honest, I don't think it's much more complicated than that anyway. I really hate all these scary terms in the investment world. It's what put me off investing for so long. And until I started researching, reading and looking at YouTube videos, everything started to make a little bit more sense and I realised it's not that fucking hard. Today I'm going to be looking at a few of my favourite REITs and I'm going to get buying. I'm pretty lucky because it looks like the world's on a down day today, so I'm actually starting to feel good about investing again. It's possible I might get a few of these buys on a discount. Arguably right now it's not a brilliant time to buy REITs. But then the same argument can be used for pretty much any company in the world. So as with every buy right now, you've got to be really sure that you want to hold these companies for a long time because they're not going to deliver anything back in the short term. And the theories are out there that in Q2 of this year, everything's going to drop by another 40% or so. So buying right now, cost averaging in, is my strategy and I've got to pick companies that I really like. And I think I've found them. So my aim is to get buying a bit more today. I haven't got a lot of free funds in there, so let's add a bit. I'm going to add 500 today. I think my aim right now is to add 500 into my account a week, just to keep the cost averaging up pretty high. And because the markets are showing signs of going down again, today could be an expensive day for me. Right, so let's have a look at the list. These are my favourite REITs. Okay, starting with the American first, Realty Income. I am not going to go into too much detail in Realty Income. There is enough information out there just on YouTube to tell you why you should buy Realty Income. It's an American REIT, it's well diversified, it's got a reasonable dividend yield and it pays out its dividend monthly. That is some regular income coming in. And many of the biggest researchers out there think it's really safe. I've had a look and I agree, so that one's going in my portfolio. Now the market's closed at the moment, but I'm just going to put in a buy anyway, £42 and click review order. For those of you new to Trading 212, what happens when you order while the market's closed is it goes on a pending list. And what you can do is you can go into your pie and you can scroll down until you see Realty Income and you'll see it's got a little timer symbol on the side there. That means the order's pending and it will make the buy at 2:30 today when the American market's open. So that one's sitting there and hopefully the American market is going to follow suit with the same it did yesterday. Everything's going to drop a little bit and I'm going to get Realty Income at a discount. So now I can focus on my UK REITs. And my first one, my favourite one, is Segro. Segro is a UK based REIT with lots of different holdings out in Europe. I think Germany and France and Poland, they're all on the list. There's a couple more as well. So it's quite exposed to all the European markets while having a lot of buildings in the UK. Segro's got a pretty average dividend yield. Its earnings per share are growing and have a look at that fucking awesome payout ratio. A lower payout ratio means it's spending less money than it's earning on giving out your dividends. That usually means it's using a lot of its earnings to reinvest in different areas. And it looks like that's what Segro's doing with huge investments over the past 3 years. I'm a real fan of Segro. It's one I really want to put a lot of money into. I feel like it's really safe. I'm so positive about it that I'm actually really scared I'm just overly biased. So can please someone find something bad about Segro for me? Just in the comments below, just give me something like their manager kicked a cat or something like that. I don't know, I need something bad to hear about them because at the moment what I look at, everything is just too good to be true with Segro. So please, someone give me some downsides to look at. Anyway, straight in there on this day, buying one, oh, buying two, buying 2 shares because it's so fucking cheap. Review order and bought. Right, that one's done. My next one is a bit of a fan favorite. It's Tritax Big Box. It's got an awesome dividend yield, and if we have a look at the share data, its payout ratio is sitting pretty much exactly where you think it should be for a REIT. Their profits are down this year, but it seems to be down to them paying off a lot of loans. Their actual revenue went up again, so I'm not worried about that one at all. It's got a great cash flow, and as with every good REIT, it's always continuing to blast money into its investing. Tritax is a real winner for me, and it's one I'm going to buy today. Buying one at £1.23. I'm going to buy a few more of those today. Boom, and we are bought. Next up is Workspace Group. Workspace own a lot of offices, mainly in London, but I think they have a lot outside of London as well. But it's mainly office space that they rent out. There's an argument out there that there may not be that much workspace needed in the future with everybody working from home. But at the moment, they're quite a positive company. And at least in the next few years, there's still going to be a need for office space. So I'm happy to just stick around for a little bit. Workspace's fundamentals are pretty good dividend yield, and the payout ratio is pretty good as well. Their revenue is increasing year on year, which is no problem for me. And as usual for REITs, their reinvestment is really high every single year. I really like Workspace Group. I actually hadn't heard of them at all until I started this YouTube channel. And someone, I'm really sorry, I can't remember who it was, left a comment on one of the videos and highlighted Workspace as one of their favorites. I had a look at everything and I thought, shit, Workspace is really good. So thank you so much to whoever that was. I looked through all my videos, I can't find the comment anymore. But thank you to whoever that was. Let's give it a buy. So I think the minimum you can buy for this is 2. Send buy, all bought. Okay, onto my REIT shit list. This is a little bit unfair on Unite Group. Unite are a student accommodation REIT, but as you can see by their graph, they are heading skyward. They're really good. They've got a lot going for themselves. This was really a 50-50 one for me, but today I will not be buying it. Fundamentals on a whole aren't so bad. Their EPS ratio is all right. Their payout ratio is pretty good. But when it comes to their income statement, you can see that last year they had a lot of payout for loans. That shouldn't be too much of a worry for these guys because it's in their plan. And hopefully for them and anybody invested in them, the share price should continue to go up and Unite should do well. But I feel like the student accommodation network is completely saturated. I really feel that there's nowhere for it to go. There is loads of student accommodation building going on, and I just can't see that they'll fill all of them forever. And the second reason, in my opinion, is that university's fucking useless. And I think people are starting to wake up to that. Unless you're going to go out to be a doctor, a lawyer, or someone in the financial world, university's fucking shit. Pretty much any job that you want that doesn't require a license can be gained just by getting experience in it. And particularly when I went to university to do some fucking bell-end degree, it was a waste of time educationally. And I think, particularly after this crisis, university is going to be pretty useless. I think there's a theme here, like I have with Cineworld, that I sometimes just let my personal feelings get in the way about some really good companies. But I think as a fundamental, if you don't believe in the company and you don't believe you can hold it forever, then I don't think you should be investing in it. But again, like with Cineworld, I don't think I can blame anyone for going for it because the upsides are there. I can see them. I can see them in the fundamentals. If you do, then fucking go for it. That's enough from Unite. That's not making it to my list. The next 2 companies are not the same. These ones, I'm telling you, avoid them. Okay, that's a bit harsh, I suppose, because as you'll see, again, it's all based on personal opinion. So if you're into these companies and you know something I don't, then fucking go for it. But me, staying well away from them. First one is Into. I wouldn't be surprised if Into goes bankrupt in the next month. That's a big call, but at least by the end of the year, that thing is gone. I probably could have told you that in 2008. Have you ever been to any of their shopping centres? Fuck, they're all empty. There are entire empty sections of their shopping centres, and I don't feel sorry for them at all. I personally think that the decline in the high street is not down to online sales. Fair enough, it's got more competition. But the truth is, these big companies that own these big buildings, they won't reduce their rents. They are asking for ridiculously high rents because they think it's worth it. And the truth is, people don't value shopping centres anymore. And any new startup company that would likely put themselves in a shopping centre just cannot afford the rent. And I'm sorry, but that's Intu's fault. If you want to survive against companies that aren't paying rents whatsoever, then you need to lower your rent and allow some local companies to start up in your area. I've got no sympathy for Intu whatsoever. They are on the brink and they are hemorrhaging money. Do not go near them. British Land is another shopping centre REIT. I feel bad for them because they're quite a popular stock. Lots of people are invested in them, but they've been seeing a steady decline since I think 2015. Throughout this entire time, they've been keeping a high dividend yield, even though their EPS is in the negative. That means that they're using their own cash to pay for their dividends, and none of that dividend being paid out is coming from their profits. It just means that every year things are getting worse. I must admit, I don't know a lot about British Land. I don't know what their strategy is and I don't know where they're going, but at first look on the fundamentals, it just doesn't fit within my strategy and it's just not getting a buy from me. If any of you guys can convince me differently in the comments, I'm all ears, let me know. But right now, the fundamentals do not look good for this REIT. This week looks like it could be a really good week for buying. The stocks are going down a little bit. I'm going to be putting in a bit more money. Keep your cost averaging going. If any of you are interested, the app I use is Trading212. I have a link in the description below. If you sign up through that link, we both get a free share. And if you found this video entertaining and useful, please like, subscribe and invest.